Good morning, ladies and gentlemen, and thanks very much, Richard, for the opportunity and the pleasure of coming and spending 30 minutes or so with you to run through some of the key messages that we've been sharing with investors in not just the year to date, but also for a greater part of 2012. And I'm also really looking forward to the panel session afterwards, which kicks off at around 12:30 thereabouts. So what we're going to do just for the next 30 minutes or so is just basically, I guess, fit in with what much of the content is covering today. That is fitting in with those personal parameters that Mr. David Gerald points out very well in the new investor guide. That is knowing your products, knowing your strategy, and knowing yourself. And what we'd like to do is to share with you some of the resources in terms of stocks, sectors, and portfolio products that are available to you on the Singapore Exchange. Now, investing, I guess, if we could just take one step back and look at the purpose of why many of us are here, and look at investing in general, then investing, we are all very much familiar with it. Most of us, I believe, are either Gateway subscribers or we're CS members here. And we understand that there is an increasing role and an increasing need for individuals to invest. If you look at official estimates, official government estimates that are taken from the IMF, the International Monetary Fund, on an annual basis here in Singapore, there's actually estimates that show we in Singapore are going to be investing more in the next 3 to 5 years. We're going to be investing a greater share of our gross domestic product in private investments over the forthcoming years. The amount, it's not a huge amount, it's an extra 1.1% of GDP, and at the same measure we're going to be reducing our savings rate, which is already very high in Singapore, by about 1.8%. So we're increasing investment by a little over 1% and drawing down some of those savings. Now, 1.1% of GDP might not seem a great deal of money, but consider that gross domestic product last year and the year before was around that 260 billion, 270 billion US dollar mark. So you're talking potentially up to around $3 billion of utilised investing in the forthcoming years. So being aware of this, what we at the Exchange and CS have been trying to do through this My Gateway initiative is to find a way to share with you the resources of the Singapore Exchange in a way that is congruent with minimising risks associated with investing, attempting to minimise those risks. Basically taking your nest egg and finding ways to spread it over different baskets. Because if you are going to be investing more, I think one of the greatest risks is to invest everything into an underperforming stock or an underperforming portfolio product. So one of the key, most elemental messages that we are trying to share with CS and investors is that diversification over different sectors, possibly one of the most elemental ways to spread the risk and to reduce the risk of investing all the funds into one underperforming stock and sector. Now, this, as we said, it's a very elemental way of reducing risk. Why it's important is because on the Singapore Exchange, you actually have one of the world's most diversified stock markets in terms of sectors, sector coverage, sector depth, as well as portfolio products such as exchange-traded funds that complement the already diversified array of stocks and sectors listed on the exchange. So, going back to this case for investing, and if we are going to be investing more, as we said, there's three key financial considerations or macroeconomic considerations that are conducing us to be investing more, being more conducive for more investment. That is, we do have, as you would know, a stable currency which is on a gradual and modest appreciation policy path. You also have moderate inflation, which I think averaged around 4.5% last year. And, of course, you have very low savings rates in the banks for those funds that you are not utilising into retirement funds, but rather trying to achieve a rate of return within the bank and keeping the money at hand. So those three factors in general do provide and support the foundation for investing in a couple of assets, not just the stock market, possibly the housing market as well. If you want to compare the Singapore housing market to the Singapore stock market, you can do it with the caveat that you only can really truly ascertain the housing market appreciation or depreciation on a quarterly basis, and the stock market, of course, can be assessed on a day-to-day basis through the real-time trading of the benchmark indices. So let's take two indices. Let's take the Straits Times Index, which is composed of 30 blue-chip stocks, many of which are household names you are already familiar with, and take the Urban Redevelopment Authority Property Price Index by residential type. Look at those two indices over a 10-year time frame into the end of the March quarter this year, into the end of March 2013. So from the March quarter of 2003 through to the March quarter of 2013, on an average annualised basis, your property prices, in terms of residential property prices, appreciated by an average of 6.4% each and every single year. That's not to say every year it moved 6.4%, but on an average basis, that was your smoothed out average rate of return over the 10-year period. On the other hand, your Straits Times Index, the stock market per se, basically, well, the top 30 stocks of the stock market, I should say, appreciated 10.4% on an average annualised basis. That does not include dividend yields, which are going on the STI, the dividend yield varies from around 2.5% to 3.5%, pending on the price of the Straits Times Index. So if you add another 3% onto 10.4%, your average annualised return of the Straits Times Index over that period, March 2003 to March 2013, was approximately around 13%. Almost twice as much as the property price market. Now, owning your own home, you wouldn't constitute as an investment in the same way you would constitute a handful of stocks as your investment. What we're really talking about here is buying a second home and basically yielding rental income versus buying a parcel of stocks and yielding dividends. So I just wanted to clarify that point. So this is what we've looked at over the last 10 years. That's not to say that's going to happen and repeat again in the next 10 years. Nonetheless, these are two key asset classes that many investors look to, and it's worth understanding the facts and comparing the different performances if you are going to be starting to reinvest or be investing for the first time. So what makes this, other than that 10-year return, what makes the stock market so different? Well, the stock market, as I alluded to just before, is a very highly diversified marketplace. If you look at the top 10 stocks on a day-to-day basis, the top 10 stocks by turnover on a day-to-day basis, there are at least 5 to 6 different sectors represented by those 10 stocks on a day-to-day basis. If you look at the wider range of stocks, not the entire 700 yet, but let's look at the most liquid and of the biggest 180 stocks, thereabouts. It's actually 183 stocks, which make up the bigger index, the FTSE All-Share Index. This is akin to the Straits Times Index being your Dow Jones, the FTSE All-Share Index being your S&P 500 per se. This FTSE All-Share Index is composed of 12 very different sector indices that have all performed very differently over the last 10 years or so. And what we're going to do in the forthcoming slides is to show you a few examples of choosing the largest stocks of these sectors together in a balanced portfolio, how that has actually generated returns over the last couple of years. In some cases, it hasn't generated returns, but nonetheless, we're going to look and compare how a balanced portfolio using a selection of different stocks does reduce that risk of being too concentrated into a potentially underperforming stock. Okay, so the examples that we're going to flick through are purely educational, and of course we're not recommending the future performance or whether the future performance or the relevance of these stocks to your own portfolio. This is just to show and educate you on the importance of diversification. So we covered those 183 stocks. If you want to look at the entire broad spectrum of 700 stocks, consider that in those 700 stocks you have 150 different types of businesses represented by those 700 stocks represented on the exchange. So as we said, many of these sectors have performed differently, and here's an example. It's a slide that we've taken together from all the different sector indices of the FTSE ST All Share Index, and does show the different cycles of the different sector indices. This is a pretty popular slide, and unfortunately we actually don't have it on SGX My Gateway. There's a similar one that CRs have in the booklet, but it's more looking pan-asset, not particularly on the stock market. So if you do wish to have a copy of this slide, and we can update it to show you what's happened in the year to date as well, if you want to have a copy of this slide, please feel free to email me at SGX, jeff.howie@sgx, or Richard Dyson as well, if that's okay. Richard, can I give out your email address? Everyone's probably got Richard's email address already, right? So email us if you want a copy of this slide, please. So what does this show you? Last year, Real Estate Development Holding Index was up 56%. Consumer goods was down 17% in the year to date. In 2012. In 2011, the STI was down 17%. Last year it was up 19%. Over the last 10 years, there's been 2 years where the STI has basically made a price decline. 2008, 2011. You can see in 2011, 2 sectors actually did perform positively in the year 2011, and some performed quite poorly in 2011. So with the diverse, wide range of sectors, we're just basically in this quarter, what we're doing in My Gateway is focusing on these 3 sectors. In the first quarter, we focused on the 2 sectors, oil and gas and telecommunications. And I brought a few slides from that sector coverage to share with you an example of just how well diversified we are in these sectors, particularly in the subsectors, in the different fields of businesses that are represented by the stocks that make up these sectors. If you consider that what's interesting is that over the last 10 years, real estate development holding sector has outperformed the market, outperformed all the sectors 3 of the last 10 years, as has utilities, which has outperformed the market which has outperformed the stock market 3 of the last 10 years as well. But utilities aren't so much an obvious name to us. There are no Straits Times Index stocks that represent utilities. We have 30 stocks in the STI and 14 different sectors representing the Straits Times Index. So that makes it a very diversified stock market indice as it is. If you consider that compared to the Hang Seng Index, while 1 in nearly every 3 stocks of the Hang Seng Index represent a different sector, 1 in every 2 stocks almost of the Straits Times Index represent a different sector. Thus, you already have a degree of sector diversification represented by the Straits Times Index, and if you wanted to take it further, then obviously there's a range of sectors that you can apply to the portfolio, which might be constructed from the Straits Times Index. I might just digress and go on a tangent just for 30 seconds here, that we do have exchange-traded funds that cover the Straits Times Index. There are 2. The State Street Spider STI ETF, which has a multiplier of 1,000, minimum investment of 1,000 shares. So trading at around $3.30, your minimum investment's 3,300 Singapore dollars thereabouts. We also have the Nikko AM STI ETF, which has a board lot size of 100 units. Thus, your minimum investment's $300 in the Nikko AM STI ETF. So that 2 STI ETFs, one of which, the latter, the Nikko AM, is currently seeking to be non-SIP, so it will be an excluded investment product and won't require SIP quizzing before investing in that ETF, and that is due to be effective at the end of April. And then the State Street remains SIP. So many investors, if you will take these ETFs and apply a strategy, a popular strategy known as the core satellite strategy, which basically has the STI ETF as your core investment, and then adopting satellite sectors, stocks that represent large sectors that investors might be more comfortable with to basically complete the portfolio. So that's one very popular sector type of strategy that investors use in the ETF market and the actual stock market as well. So as we said, these are all going to be educational examples, and we're really looking at diversifying, the message of diversification, not putting all the eggs into the one basket. We've got a couple of examples, and these are the examples and much of the educational content that we're focusing on in this financial quarter. As you can see, we've chosen the three largest stocks in terms of market capitalisation of these three sectors. Jardine Cycle & Carriage, which is the largest stock of the consumer services sector, Hyflux, which is the largest stock of the utilities sector, and Hong Kong Land, which is the largest stock of the real estate sector. And looked at diversifying across these three stocks in the last 12 months, ending at the end of March. As you can see, the portfolio is very unbalanced because the trading price of Jardine Cycle & Carriage this time last year was around $48 versus Hyflux, which is trading around $1.50. So if you're applying the minimum board lot size of 1,000 shares of each of these two stocks, you can see your notional value is going to be so much higher for Jardine Cycle & Carriage than it is for the Hyflux stock representing utilities. Thus, you basically have a non-balanced portfolio. That's represented by this pie chart in the bottom left corner. As you can see, much of the blue is the value, the dollar value of the portfolio in Jardine Cycle & Carriage. Now, while over the last 12 months this might have suited you in a backfitted type of way because of the outperformance of Jardine Cycle & Carriage, it's not going to be balanced in terms of enabling you to spread the risk over different stocks in the most optimal manner. Consider if Jardine Cycle & Carriage had actually declined 6% in price and not gained 6% in price, you'd have the reverse effect on the portfolio. Thus, investors might seek to balance the portfolio, to balance your portfolio so it's evenly weighted to three different sectors, which, as you could see over the multicoloured matrix we had before, have performed differently over the last 10 years. If you had that balanced portfolio in the 12 months to March 2013, your total return on an initial outlay of around $150,000 would have been around 12%, 12 to 13%, not including transaction costs. As you can see, we had to buy many more Hyflux shares, 32,000 shares of Hyflux, to come up with the same notional value of Jardine Cycle & Carriage. Going back to the year before, so you're looking at the year of March 2011 to March 2012, you can see a balanced portfolio gave you a total return of minus 2.7% over that 12-month period. You can see there were two stocks that actually did underperform the market, I should say. Hyflux, representing utilities, had fallen by 30%. Hong Kong Land had fallen by 17% over this time frame. But on the other hand, the other sector stock, Jardine Cycle & Carriage, had gained 32%. Thus, all in all, the total return was minus 2.7% over that 12-month period. So the example is there not to make the case for Jardine Cycle & Carriage. Rather, what we're doing is showing and trying to exemplify how diversification can spread the risk and obviously spread that return as well over a year to year to a year to a year basis. Also, as we said, there's a lot of sector diversification within the sectors themselves. Obviously, the real estate sector is pretty big. You have real estate holding and development companies on one end of the sector, then on the other side, you have real estate investment trusts, two very different vehicles. Real estate holding and developing companies, the developers, they're all companies. Real estate investment trusts come under the collective investment scheme as trusts per se. So very different vehicles. that we have. Do we have some real estate investment trust material coming up next week? We do, right, Richard? So if you are already aware of the real estate investment trust market, or you want to be reacquainted with, I'm sure there's going to be a series of seminars that obviously that CS is conducting. This being an investment week, and we will also talk about them in a little bit more detail at the SGX as well during the week, in tandem, in work in conjunction with what CS is doing. So just to show you, these are the three largest stocks of these sort of different sectors, because you have Capital Land being the biggest local developer, you have Hong Kong Land being the biggest regional developer, and of course Capital Mall Trust being our longest, oldest and biggest real estate investment trust in Singapore. In the 12-month period to March 2013, you can see that each of the stocks did make a gain. Total return was 22% across the sector. But more importantly, this is the slide I wanted to draw your attention to. This is in that year, 2012. 2011. And remember, 2011 saw the STI fall 17%. And 2012 saw the STI gain 17%. So while this was echoed through the sector in 2012 in terms of the gains, you can see in this 2011 year, the developers actually generated a loss, and the real estate investment trust actually generated a positive return. And thus, by spreading the real estate investment over three distinct subsectors of real estate, you can see during that declining year, you're able to diversify the risk and the return of the investment. We've also been looking at the oil and gas sector and the telecommunications sector. We've just got a couple more examples here. This, firstly, is an unbalanced view of telco and oil and gas, but the more important aspect is, although this returned 20%, the more balanced portfolio returned less, 17% in the 2012 year. Like the preceding examples, having the balance is important, because if you can remember that multicoloured slide we had up before, we had telecommunications up 5%. There were two sectors in 2011 that outperformed the market. Telecommunications and utilities both generated a positive return in that year when the STI was down 17%. So while the 17% gain in 2012 did resemble somewhat the return of the STI, go back to 2011, and having the unbalanced portfolio in 2011 returned minus 9%, but having the balanced portfolio in 2011 returned minus 1.7%, because you took two very different sectors. One sector in a 5-year period has been the most volatile of all the sectors in terms of the price volatility, price variation of the sector. And on the other hand, the other sector has been the least volatile. The volatility of oil and gas stocks over the last 5 years has been twice as much as the telecommunications stocks. And thus, as you can see, they have had very different returns. So you've taken two sectors that have performed differently, and I'll show you very soon another quick slide that shows you and exemplifies how different the volatility of these stocks have been, that have returned a return of minus 1.7%. Just one more final example in these portfolio balancing effects. You can remember in 2012 that we had the real estate development and holding sector up 56%. Consumer goods is right down the bottom, minus 33%. Biggest stock of the consumer goods sector is Wilmar. If you had a portfolio in 2012 that had the biggest oil and gas stock, the biggest telecommunications stock, and the biggest consumer goods stock through Wilmar, your return would have been just up 0.1%. So it would have been even. You neither made a return nor a loss in 2012 if Wilmar was 1/3 of your portfolio. If Wilmar was 100% of your portfolio, you would have made a 33% loss. Okay? So we're basically making this final point by looking last year at the underperforming sectors. We haven't chosen the outperforming sector here. We're just showing that example of spreading the risk over three very different sectors over a long period of time. So just some information on the sector stocks. Now, oil and gas stocks. Everyone is probably aware we've got some big oil and gas stocks, the most popular of which are Keppel Corp, or Sembcorp Marine, Ezion, big oil and gas names. But if you look at the sector itself and start to focus on what the sector actually does, how it's relevant, how it applies to the world, how many of those 30 to 40 stocks actually are involved in the search for oil? How many are actually drilling for oil? How many are actually producing oil? How much oil of these oil and gas stocks is taken out of the wells and shipped off to end consumers? We actually have quite a diversified ecosystem of the whole upstream to downstream business in Singapore. Most of the stocks that we have are involved in servicing the upstream oil explorers and producers. Suffice to say that we do have 5 oil explorers listed on the exchange, 4 of which are on the main board, 1 of which is on Catalyst. Now, the 4 main board oil and gas stocks, they all have production sharing contracts or ventures that are in Indonesia, some of which have RH Petrogas, which is the largest in terms of market capitalisation, and it's the largest in terms of production, have interest in Malaysia and Myanmar, and Interra Resources is the second biggest, also has production sharing contracts in Myanmar, and Marak also has interest in Cambodia. So they're all regional focused, looking for oil. The amount of oil that they produce, RH Petrogas produces around 6,000 barrels per day in their oil production. So these are, I guess, the pinnacle of the ecosystem of the oil and gas sector. These are the stocks that are looking for oil, and then all the service companies, the oil equipment and service companies, and the shipping companies, if you will all look to service these type of companies. So while these type of companies very much rely on the price of oil, there are a number of other companies in the sector that very much rely on what these type of companies are doing. That includes your Keppel Corp and your Sembcorp Marine, of course. So the objective of these 4 oil and gas explorers, while not a big part of the market, can be a big part of the global economy, obviously. And what these stocks aim to do is to turn resources, potential resources, into contingent resources and then into reserves, so that they then produce those reserves and so forth. And we have a large number of companies that are servicing these oil field companies, and these are listed below, starting with Ezion, Ezra, and Civmec, and so forth. And then there's companies that build oil rigs and companies that build ships that are part of the oil and gas sector. So all in all, there's 3 different core components, I guess, of the oil and gas sector, and these 3 different businesses that are attuned to their own business cycles and offer a level of diversification within the sector as well. So I guess the objective of those 3 slides is to just show you that while we had a number of examples of different sectors, there is also a great deal of diversification within the sectors as well. And if you consider, as we said, the volatility of oil and gas is generally twice as much as telco stocks, that can pretty much be well represented by the beta of the historical beta of these stocks. Now, all historical beta is doing is comparing on a day-to-day basis the average returns of the stock compared to the Straits Times Index. So if the Straits Times Index on average moved up 1% over the last 2 years and the stock moved up 1.5% on average over the last 2 years on a day-to-day basis, then your market beta would be 1.5. It would be perceived to be a high beta stock with more volatility in returns than the STI. And that's where you can see many of the oil and gas stocks, large oil and gas stocks fit in terms of this chart, which shows you the market beta on the horizontal scale and the total return in 2012 on the vertical scale here. So you have quite in terms of market capitalisation, which represents the size of the dot, you have quite a high degree of difference and range in market capitalisation as well as market beta over the last 2 years. The less beta stocks, as we said, telecommunications have been less volatile than the STI. That can be looked at on an individual basis, and you can see that Singtel and StarHub, on average, on a day-to-day basis over the preceding 2 years, moved 0.5% for every time the STI moved 1%. That's not to say that happened on a day-to-day basis. It's just an average, all-out average observation over the last 2 years. So these stocks were perceived to be less volatile than the Straits Times Index. So there's quite a contrast. And that's a way also, when you're looking at the different 12 sectors and looking to choose stocks within the different sectors, investors might consider the volatility differences of the stocks and how comfortable, first and foremost, that you are with the volatility of the different stocks that make up these sectors. And back to the consumer services and the utility stocks and the real estate stocks that we started to look at through these sector applications. This is a chart some investors will consider as well. What is the yield? What is the average dividend return of these assets that you might be investing in? And how does that compare to the day-to-day average volatility of these stocks as well? Because if you are in the market and looking for stocks that have generally showed a history of being less volatile than the market, with a higher dividend yield than the market, as represented by the Straits Times Index, then you're able to look and compare and plot those two parameters together to work out what stocks might be more relevant to be on your radar. For instance, if you look at, in this example, you can see the real estate investment trusts. It should actually be Ascendus, Suntech REIT, and Capital Commercial. Capital More Trust should be higher. It's just that this data is taken from Bloomberg, and it's taken, Capital More Trust had 5 dividend distributions in 2012 rather than 4, and it's basically, Bloomberg's taken the last dividend distribution of 81 cents and multiplied that by 4, where it should actually be multiplied by a much higher number, because it's just using Bloomberg methodology that has actually given a less indicative rate than it should be, down here between 1% to 2%. In general, that should be, if you look at the historical dividend distribution of 2012 versus the current price, your dividend yield of Capital More Trust is up around this 4% level. So clearly, in terms of the lower beta and the higher yield, your top 4 or so stocks, in terms of the biggest stocks of both consumer services, utilities, and of course real estate, have shown real estate investment trusts to be of that lower beta, higher yield nature, versus some of the developers which have a more average yield corresponding to similar yields of the STI, but also a lot more cyclical and a lot more higher beta than your real estate investment trust. So we did make that point. I did just sort of make that discussion point earlier, that real estate investment trusts are a very different spectrum to real estate developers and holdings companies. So hopefully this chart illustrates that point. So there's if you come along to some of the events SGX is holding with CIAS in the forthcoming week, which we more than welcome you to come along. We're going to be looking at these sectors in a little bit more detail. The subsectors that make up the consumer services, the subsectors that make up the real estate companies and those bigger stocks, as well as the electricity and waterwork companies that make up the utility sector as well. So that's what we're going to be doing, ladies and gentlemen, next week. And for the next, I think the plan is to work with CIAS to provide more sector resource knowledge and events over the forthcoming 12 months or so. And if there's any questions of the material we just covered. We obviously went through a lot of material, and if there was any point that stuck out in particular and you'd like to discuss, please do so in the question and answer time. And of course, I'll be hanging around outside by the booths for an hour or two after as well. So again, thanks very much, ladies and gentlemen. Thank you so much for your time, and we'll see you again soon. Bye.